All right, welcome everybody. Hopefully you can hear me, maybe see me, and also see our screen. All right, so today is what, the 18th? Yeah, unbelievable. 18th already of January. All right, so welcome. Today is the client support webinar that we hold each and every Wednesday for our clients. And the purpose of this webinar is to answer your questions, cover a couple topics, and anything that you find pertinent you want to talk about. So that's kind of what we do here. You'll probably learn something. We try to cover a topic every week that's kind of helpful, I think, in navigating your way around the trading environment. All right, couple things here. We got to go over the risks involved in trading first. Like I always say, without that risk, there is no opportunity. But there are risks in trading. It's possible to some or all your money trading or even investing in the financial markets. So know that that risk is a possibility. But you can protect yourself. You can trade with money you can afford to risk. You can also calculate your trade size and things like that. We've got some books on that. Gene will cover that at the end of the session if you're interested in that. Also, too, check with your financial advisor, money manager, of course, before implementing any of the trade recommendations or ideas that we talk about here, because we don't know your personal situation, and of course, they do. Okay, so let me come out of here. Oh, wait, one more thing. I also wanted to cover one thing here. This is something I think is a great thing to talk about. Don't trade your last trade. What do I mean by that? Those of you that are here, what does that mean to you? And why do you think that's important? Anybody? Got a good turnout today. All right, psychology, good. What else? What about psychology? It is very, okay, all right. That's right, I'll repeat that in a moment. All right, so basically what we mean by this is no matter what happened on the last trade, don't take the emotions that last trade generated and bring them over into the new trade, because technically every trade is brand new, and that's the way you should treat it. I can't tell you, it's such a part of being human where we are always have the tendency, or at least the emotions are there to trade your last trade, and it's not a good idea. And things that worked on the last trade, all right, that maybe or didn't work on the last trade doesn't mean it's going to happen on the new trade. Okay, you have to approach each trade using your tools that give you an edge built on that edge working over time. Okay. Okay, you can't do that. You can't bring your last trade. And if you emotionalize a losing trade a lot, it's going to be on your mind a lot. And that's what really hurts people when they go ahead and take a new trade. They bring those emotions over to a brand new day or a brand new trade, and not good. All right, it's not easy, okay, to let go of that last trade, but you have to. All right. So when you wake up every morning, when you're about to hit the trading button, remember this: don't trade your last trade. Really important. Okay, so let me come out of here, and I want to cover real quickly something else that I've been receiving a lot of emails on. And again, if you have any questions, feel free to ask. But one of the things that people have a tough time with is when drawing fibs, whether they're extensions or retracements, they're having a tough time finding wave 2. How many people out there are having a hard time doing that, or maybe not even know what I'm talking about? All right, so let me know. So, when you have a new trend, usually the new trend emerges, and if it's out of a breakout market, it'll look something like that, right? Starts to break out. All right, so that first breakout, all right, chances are is a 1 if it's a new trend. And then what we have to do is wait for 2. And once 2's over, by taking out the top of 1, all right, you have a situation where you're in 3. So here's your 2. Then 3 comes, all right, and then you have a break in 3. And there's your 2 anchoring points for your fib retracement, right? This area here is what gives people a hard time. And I'm going to give you a really simple formula. When you look at a trend, always try to, and you can draw a fib. So that means you have something where it's broken out. Maybe it's a little messy, comes down like this and then goes. All right. People have a hard time. Is this 2 or is this 2? How many people, oh, geez, messed that up. All right, hold on. Let me redraw that. So I'll call this point A and point B. This is the start of the trend. Which one of these is 2? Which one of these is 2? B, right? Why is B 2? Why isn't A 2? If you can't answer that question, that's why you're having a hard time finding 2. Because 2 has to be the deepest pullback on the beginning of the new trend, but not take out the bottom or 0, the start. So if this is 1, this is going to be 2. What about this? Start here, move up, lowest, 2, 1. Okay, so when you're looking at a chart and you're having a hard time finding 2, find out where the trend started and then pick the next lowest low. That's your 2. And you'll be right about 99% of the time. Very rare that that's not right. There's exceptions to everything, but stick with this. Because that's one of the biggest problems people have. Now, you're not going to know. Let me ask you another question. Let's say you have this and you have this. Is that a 2? You really don't know yet, do you? Because the top of 1 hasn't been taken out yet. Right? So in order to really know 2, you got to have wave 1 exceeded. And then you put your stop under here. And then if it fails, then maybe this is an A, this is a B, and that's a C, and you had the wave count wrong. Or maybe some type of alteration in there, okay? But as a general rule, when you're drawing fibs and you get the first pull up, no matter how zigzaggy or messy this is, all right, the furthest low is always 2, provided wave 1 is taken out and provided the bottom holds. Does that help? Because I get asked this a lot. A lot of times you'll have something that looks like this too. You'll have a point here, you'll have a move up, move down, all right? And then you'll have a broad-based move, move down, broad-based up, things like that. All right, 1, 2, okay? It's always the lowest low in the pullback. Okay? Good, Kumar, good. All right, because that gives people a very hard time. All right, and so that's kind of the way you want to do it. So like on a situation like this chart, and this is a weekly chart, but same difference. All right, if you have a bottom here, okay, and you have your first pull up, all right, so far this is the lowest low and it didn't go below the bottom, but technically we don't know if that's a 2 yet until we get above here, okay? In that case. And same thing with a B wave. If that's an A, that's a B. B cannot go below, for the most part, the bottom of 3. So both result in a bullish trade. You just got to figure out if it's a correction or a new trend at that point. All right. All right. How many people got into Bitcoin? Okay, we've been pounding the table for the last couple of weeks on this. All right, still pounding the table. Now, let's take a look at this. Okay, this is the daily chart on Bitcoin. So this could be, let me just redo my pointer here. 1 second. Okay, so far maybe a 1 up, could be coming down into 2. We'll see if this bottom holds. So if you want an early entry, your stop's got to go down here because we don't know how low 2 is going to go. And maybe it's not the bottom. Maybe it'll come down and go down lower and stop us out. That's why we use the stops. But I think that's a pretty good bottom. All right. Short-term target is here, just in case that's all it's going to give us. The long-term target is above the all-time high of Bitcoin. All right. So it's either going to be a major or a minor bottom, and we'll reassess it when we get up there. Okay. Anybody in this one? Hopefully you are. If you're in the Moore report, you're in it. Okay, nothing wrong with that, Kumar. You could wait for a retracement. Okay, and you'll probably get one. We're looking at 995 to 914, probably as a retracement on this. But you know, if it's a wave 2, it could go all the way to the bottom. So we'll kind of keep an eye on it. You've had a long owl, right, on the 60-minute. So you know we're due for a correction. The question is will it hold, right? Will it hold? Okay, Lee, UGL. What are you doing with UGL? Are you in it? Thinking about getting in it? What are you doing? Anything specific on that? In it, but okay. All right, well, good. It's been a pretty good trade so far, right? So here's one where you got to think about what your intentions are, okay? So you've got a bunch of different time frames to look, and here's kind of how I would manage this. All right, the long-term aspect says we're probably going to get above 85. The problem is this indicator called the PTF, which is 75% accurate. It's not going to tell you when that's going to happen or what kind of zigzag it's going to take to get up there, etc. But it says it's going to get up there. So we may assume this may be a bottom here. We've got green here, we got green here, green here. Yellow is okay, as long as it's not red. So everything looks pretty good. We're probably due for a pullback at some point, but it's pretty strong. Now, the pyramid for a position trade is way back here to try to give it enough room for a pullback before surging forward. Now, if you wanted to, and here's the benefits of using multiple time frame analysis. I don't know where you got in, but let's say you got in early down in this area here. You're sitting with quite a bit of profit. You could have scaled out here, okay? Let's say a 30-year position maybe or something. But again, it depends on what your intentions are. And let's just take a quick look and see what that low was on the pyramid here. So our software tools put that support area as a key level of support that if broken, we may be almost done with wave 3. So that low was 60.02 and we're at 60.02. So technically we have to go 1 tick below it, and we did. All right, so you technically could have scaled out today of a partial position on that if you wanted to. Take a little profit. If it corrects, you can always get back in or just be satisfied with a little bit of profit, let the left go until actually stopped out on the daily chart. Okay, so that's one method of doing it. The other method is to basically rely on the PTF here and say, okay, we're going up here, stop is here, and I'm going to let it run. The problem now is that it's gotten so far away that your risk to reward is 1 to 1. So that's not a very good technique here. So you're probably better off doing an option play or something where you could limit your risk based on that and try to use the leverage to knock the risk to reward up. But in any case, you will get a correction on this. Okay, you may get one more high before you get it, but it's getting close. So you have to see what your intentions are and how long you want to be in it. Does that help? Hopefully. All right. So I think maybe where do you how much profit do you have? Do you have enough profit in this? Because if you just got in, then I would say use the stop on the daily chart and just let it run. But if you got in a while ago and you had a lot of profit, I'd probably scale out of a third or even a half up here. Okay. Okay. So that's kind of how I play it. But you see, that's the nice thing about using multiple time frame analysis is it gives you a broad view of the market. And if you were just looking at the daily, you would have no idea that you could have potentially scaled out using that. See what I'm saying? Okay, so you're in at 56. So you don't have that much profit, a little bit. But it, next correction, it could come right back into the mid 50s again. All right. So I guess, depending on what your target, if your target is up here, then don't do anything. Let it run as much as you can and use this stop. Okay. My only thing with something like this that I would suggest is you got in here. I don't know how you found it to get in here, but you got in late. And so whatever source you're using to get in, all right, it puts you in late. So you may want to make sure you check that technically next time to make sure you're not getting into trends late. So just be careful about that. We're just going through all the comments right now, so give me a second. My pleasure. See, even if we look up a stock, it can always be a educational thing, right? I mean, everybody can learn from it. This gives you a great example on, you got to figure out what your intentions are. And before you take the trade, the other thing too, here's what I usually find out with folks. When they get in late in a trend, instead of getting in down here, all right, when they get in late, the problem is they probably don't have a clear view of the target from a technical standpoint. So you gotta kind of make sure if you're going to get in here, where's the target versus where you can put your stop, and does it make sense from a risk to reward standpoint? Okay. Well, it definitely it is going to go up. Okay. In fact, we're very bullish on the gold market, but the problem here is risk to reward versus your stop and where you're going to put it for a pullback and so forth. Because if you look at the GLD contract, you're going to see a very similar situation. All right. Now we recommended this a long time ago where we could get in early enough and get our stop low enough. All right. If not down here for the risk to reward to make sense, because our target on this one was based on the Elliott wave being pretty clear up to 201 to 233. Okay. So the risk to reward where we got in made sense, but you have to get in early. And this is due for a pullback too. It looks just like the other one. See, here's your stop hit and you can get out. Now for us, we're not getting out because we're in early. So my stop is there. I'm going to let it come down and go back up. And that is part of trading that you have to come to grips with as well, because when you're trading the financial markets or any market, it's always surges, pullbacks, surges, pullbacks. And The surges create the emotion for profit taking. However, if you're in the infancy of a move, then chances are you're going to get out way too soon and never reach your target. Okay, we all experience that, right? Okay, we experience it in the day trading room. We experience everything. The emotions are right there to want to take that profit. And the problem with that is that if you go in with that mindset, then you're constantly going to be getting out. And chances are, if the market comes down and recovers, you by the time you get a clear entry again, it usually is above the price you got out at. How many times has that happened to people? Okay, so it's a tough game to play it like that. All right, so the thing is that you've got to have what your intentions are before taking the trade. It's your intentions to make it to the profit zone or just the current impulsive wave. Like this is the impulsive wave up here. Okay, so if you're just trading this impulsive wave, then I'd probably scale out here and put my stop here and be very aggressive, because when this corrects, that's the end of the impulsive wave. And that was my intentions, just to trade that. And then maybe get back in again, maybe not. But on a long-term trade, okay, your intentions are here, which means that you got to be careful and not have your stop so close that the zig and the zagging takes you out. So it's a different mindset. Is that clear? So I do think, Lee, that's a good trade. I just think it's all going to be how you manage it, okay? And the interesting thing is, I think, as we all know here, is that trading is really a psychological game in as much as it is a science. You know, the science is our trading rules. The science is this stuff. The science is fibs. All that's this Elliott way. That's kind of the science. But it really is a psychological game. And the markets do a great job of ferrying out your weaknesses, because that's what it's designed to do, because it's based on psychology. It's the interaction of traders, okay, and taking advantage and disadvantage of the moment. And that's all about greed and fear. So what you're seeing, the reason why the market is so tough psychologically is because it's basically your mindset based on what you're looking at here. And so it triggers all these little places to take profits, and because you get fearful of the greed or the fear of the pullback, right? So it does a good job of that. So that's why you have to have some type of game plan and try to stick to that as best you can in the form of structure and so forth. And risk control. You can't let your risk get out of hand. There's sometimes, like when we test things, always test it. You can test as much as you want, just make sure that when things don't work, your risk is never exceeded. And that's usually a 2% loss based on your overall account size. Okay. So, again, just like we said before, don't trade your last trade. Think of every trade as a new one, and then reassess your intentions there. All right, anything else? So is everybody pretty clear on how to draw in the lowest low after the breakout? What do you think? Sure. So, let's just take a look at this chart, because this is not so easy. All right. So on this little impulsive wave here, where's wave two? You had a bottom down here. What's the lowest low after the first surge? Right here. That has to be two. Not as clean cut as some of the other twos, right? but that's 2. So if you follow the rule base, it's always the lowest low after the pullback once the other high is exceeded. See? So if we, if we had a situation like this, okay, we could not say that's wave 2, because what happens if it came back down and formed a lower low? So it has to go above the peak at that point, and then that's the lowest low. And you want to have at least 2 or 3 price bars on the pullback if you can. So again, just a recap on that. So if you had a trend up and it started here, okay, broke out here, all right, then if it came something like this and got zigzaggy and, up like this, well, this is the lowest low, so that's 2 and that's 1. Now, why is that important? Well, because when we draw our fibs, we have to know where wave 2 is, right? And that's what gives people a hard time. So as soon as the breakout after the lowest low occurs, then that's more than likely wave 3. And then when wave 3 ends and starts coming down, then that's going to be your anchor point here. Now, if you're using our software tools, all right, chances are this break here, well, it has to be for a wave 4 to be a wave 4, this eventually has to go red, but it may not go red until a little further along in the retracement. So then we take a look at when it goes below this area here, then we have a pretty good idea of where wave 4 is going to be, because then you draw your anchor here and here. So wave 2 is really important because it is one of the important anchoring points, not only on the retracements, but once wave 4 is over, all right, then you have to anchor your fib extensions on 3 points here, here, and here. And that gives you your target up here for wave 5, okay? So again, easy way, major first significant low after a breakout or after you've identified the new trend. Okay. All right, well, let's end it here. I think that takes us to the half an hour. I don't see any other questions coming in, so I think we're good. But I think that was a good thing to discuss because I think that's kind of a common issue a lot of folks are having, and I get it. It takes a little while for that to take hold. All right. So listen, good turnout today. Thank you so much for being here. And I'm going to turn it over to Jean. Yeah, I'm going to turn it over to Jean for just a moment, and she's going to go over. If you're interested in the book, she's going to tell you how to get them. And let me bring up this again here, Jean, for you. Okay. And I think what we want to do is go here first. And she's going to talk to you a little bit about the books. If you're interested, you can stick around and listen to that. And also the software she's going to talk about too. So you can hang for that. Otherwise, then I will see you next week. Okay, Jean, all yours.
Okie doke. Well, great session. You guys have great questions. So definitely a shout out to Lee, great questions, and Kumar, awesome. And a shout out to Antonio, all the way over in London. He and I were on the phone the other day, so he's here. So on Skype. So anyway, give me any questions that you might have in the questions area. That would be so helpful. And I wanted to mention that in the chat area, if you can see the chat area, I've posted a link for Bennett's books, and those books are awesome because they give you all of the formulas and the content that you need to implement his strategies. If you can see the link, let me know, and that would be helpful. Also, too, there's a link for the traderscoach.com website where you'll find all of the software tools that Bennett's using. You'll notice that having the right tools definitely gives you the information you need to make the right entries and exits, so that's crucial. The software tools cover a variety of areas in trading that are important, entries and exits, that's the ART software. Also, too, the enhancers, the OWL, PTF, TLM, and the ERI. those help you filter out trades that really just aren't worth taking. They also give you very important information as to, for example, the PTF tells you with a 75% probability if the trade's going to continue in the direction it's been trading. So that kind of helps you determine whether to scale out or not. And then, of course, there are scanners. We've got 4 excellent scanners that help you find the best trades. And then the money management software, which helps you manage your trades. And Lee is talking about the books. Yes, indeed, Lee. Great. Thank you for buying the books. That's great. Lee's saying that it's helpful. And now Lee would like to know what's the next best book to get. Well, Lee, I have to say, I know you're interested in money management, and I know you're also interested in Elliott Wave. So I think it's a toss-up between the Elliott Wave book and the white book, the Trader's Money Management book. Those two are really excellent in terms of giving you a real deep dive. The green money management book is sort of like a Cliff Notes, kind of a quick read with lots of formulas, lots of info, and very inexpensive to get. So couple of coffees at Starbucks is maybe the cost of it. So I think $15 on Amazon. So I think that's the best. Anybody else have any other questions? I also see, oh, good to see you, Michelle. Chai is here. Michelle, I know you're using the art software, so if you need any help on your software, this is a really great place to come. I know a lot of you in the room have all the software already. This is a great place for you to kind of get Bennett to help you with that. Well, if there's no other questions, I think, Bennett, maybe we'll wrap it up here. But really great session. Love seeing everybody here, and have a great week, and we'll see you next week. And every week on Wednesday for client support.
All right, thanks, Gene. Good job. All right, also too, just a quick reminder, you know, we do record these, so all the recordings are put on our YouTube page, but they're all unlisted because we hide them. We don't want the general public to peer in on our client support sessions, but you can, and you can access a direct link to those in the client support area, you know, the VIP area where you log in. There's an area, a little box in there when you log in, you'll see it that says client support recordings. So click on that and we'll take you right to the YouTube page where you can view all those unlisted videos for the client support. All right, so that is it.
Hey, Ben.
Yes, Lee, I think a great book for you would be The Money Management for Traders if you don't already own it. That's a good place to start.
You know what I forgot to mention? The YouTubes on Fridays. How many of you guys, let us know, give us a yes or a hello or YouTube in the comments section to say that you've joined us on the YouTube events. Just curious, because I know a lot of you come to the YouTube. Lee, the YouTube on Fridays it's live every single Friday. It's at 8 a.m. Pacific time. And yes, Kumar, I've seen you on the YouTubes. Yep, good to see you. But Lee, join us for that for sure. I typed the link in. I'll do it again. But those are incredibly useful, and you'll get great picks. You know how Bennett had some really good picks just today? YouTube as well. You'll find some really great picks to check out on the YouTubes. Yes, indeed. So I just posted the link again. Definitely join us, 8 a.m. Pacific time every Friday.
Yeah, one more item just to throw in on that, on the YouTube sessions. You know, when we started it out, it basically was primarily thought of as a place where, you know, you could bring your stocks and I'll give you a second opinion. But what it really has also turned into is a stock picking service, because everybody brings their stocks. And by the time we're done, we'll find maybe 3 or 4 really good ones, and you may not be aware of those. So those actually, you know, can be ones you can use if you're interested in trading those. So it's really turned into a really cool service. And then at the last, I don't know, 5 or 10 minutes, I take a look at the day trading timeframes for all the micros, you know, the futures markets, and you know, the MES and things like that. And so I kind of let it run till the end of the time on that for a few minutes, So it's a little bit of everything, but it is a really, really fun time, and it's on YouTube. Everything works well. So definitely check that out. Love to have you there. More people we get, the better, because that means more people will bring more stocks. So everybody wins, that type of thing. All right, well, we'll see you next week. Thanks so much. Gene, thank you for coming on.
Oh, sure. Bye, everybody. Have a great weekend.